Welcome to part 3 of our breakdown on inflation. If you've been seeing the signs of inflation in your life, you know that someone has to do something about it. Because prices shouldn't stay that high forever, right? Right. That's what we're covering today as we Pareto inflation. In the United States, our nation's central bank, the Federal Reserve, the one that manages the money supply, has different tools to control how much money is out there. The biggest one? Interest rates. Namely, the Fed funds rate. This is the rate at which banks, Chase, Wells Fargo, Bank of America, can borrow money from the Fed so they can do stuff. How does this affect you? Well, if the Fed thinks there's an unacceptable amount of money out there, they would charge lower interest rates to banks when banks borrow money from them. That means the banks pay less interest on these loans and can charge lower rates to individuals when folks like you and me apply for loans. And if rates are lower, it means more people can take out those loans. Well, suddenly, everyone has more opportunities to borrow money, start their businesses, and buy houses, which sounds great. But there's another side to this story. Speaking of housing, let's say you want to buy a house, but can only afford a mortgage payment of $2,000 per month. Let's also say you're in a non-Los Angeles housing market and find a home priced at $400,000. So you put 20% down and need to borrow $320K to pay off your mortgage principal. Now, if this were the mid-90s, you'd be collecting Beanie Babies. The Fed fund rate would be around 5.5%, and you'd actually have 8% interest rate on your mortgage, making monthly payments around $2,350. Unfortunately, that's above your budget, meaning you can't buy a home. But if you were dabbing in the mid-2010s and just getting on Instagram, the Fed fund rate is almost zero, hovering between 0.1% and 0.5%. Therefore, the interest rate on your mortgage could be 3%, making your monthly payments only $1,350. Suddenly, thanks to a favorable interest rate, home ownership is possible. Lowering rates so consumers and businesses can purchase things they normally couldn't afford happens across every industry when the Fed fund rate is low. This increases the demand for loans and increases the money supply in the market. And if there's more money in the economy, it could actually lead to inflation if interest rates remain low. You can also cut off inflation if you increase those interest rates, but depending on when you do it, it can also slow the economy. Cue the dramatic reveal of a second tool. Reserve requirements. Think of this as a rule for banks set by the central bank, aka the Fed. Little banks got to do what the big bank wants. Now, you might think banks can loan out as much money as they have in their deposits. If a bank has $1 million in deposits from people and businesses, can't they loan that $1 million out? No. They can actually loan out more than that by borrowing from the Fed itself. How much? That's where the reserve requirements come in. Let's say the Fed sets a 10% reserve requirement. This means a bank that wants to lend out more money must have at least 10% of the money in its current deposits before it can do so. So a bank with $1 million in deposits can loan out $10 million. This is why when banks lend out more money, they effectively put more money in the economy, which increases the money supply. Now, just because the bank can give out more loans doesn't mean it will. There has to be a demand for more loans. If there isn't demand, lower interest rates could increase it. In short, the reserve requirement doesn't necessarily change the money supply, but the combination of reserve requirements and interest rates do, which allows the Fed to attempt to cut the legs off of inflation. Lastly, there's a third tool the Fed uses: quantitative easing, aka buying and selling government bonds in the open market. When the Fed buys bonds from the government, they're effectively giving them a loan. This increases the money supply because the money flows to the government, who then spends that money in the economy. When the Fed sells government bonds, it decreases the money supply because it's taking money back in. But quantitative easing is a much less commonly used monetary policy compared to changes in the Fed funds rate or bank reserve requirements. In fact, the U.S. has only used quantitative easing 4 times since 2007. It's generally only used when interest rates are near zero, when lowering the Fed funds rate is no longer an option. In conclusion, according to monetarism, when central banks allow for too much money in the economy, money is no longer scarce, it loses its value, and inflation occurs. So now you know inflation, what to look for, how it happens, and how it's controlled. But before you go, did you want to check out my Beanie Baby collection? It's still worth something, right? Thanks for watching the Pareto Breakdown. Have a topic you want us to Pareto next? Let us know in the comments. And if you want to learn more about the practical MBA and what we're building, you know the drill. Like, comment, and subscribe.